Imagine a loaf of bread that costs twice as much by the time you reach the checkout line. That's not a hypothetical. That's hyperinflation. Welcome back to MoneyMind. We've spent this season inside the machinery of government finance. Money supply, reserves, recessions, central banks, budgets, and debt. Today we close out Season 3 with what happens when that machinery breaks down completely. Hyperinflation and debt default. Two words that show up in headlines during a country's worst financial moments. And today, we're defining exactly what they mean. Let's start with hyperinflation. Regular inflation is prices creeping up gradually, a slow leak. Hyperinflation is the whole tire blowing out. It's extremely rapid, out-of-control price increases that destroy the value of a currency in a matter of weeks or even days. Picture a bakery repricing its shelves every single morning, not because the bread changed, but because the money buying it lost value overnight. When a currency loses trust that fast, people rush to spend it immediately, before it's worth even less tomorrow, and that rush only accelerates the spiral. Now, debt default. Governments borrow money just like people do, by issuing bonds and promising to pay investors back with interest on a schedule. A debt default happens when a government fails to meet that promise. It misses a payment or can't repay what it owes at all. Think of it like a country calling its lenders and saying, "We can't cover this payment right now." That single moment can shake confidence in a nation's entire financial system because the people and institutions who lent that money, pension funds, banks, other countries, were counting on being paid back. Here's why we're covering these together. Hyperinflation and debt default often show up as two symptoms of the same underlying problem: a government that has lost the confidence of the people and institutions it depends on, whether that's citizens holding its currency or investors holding its bonds. One breaks the value of the money, the other breaks the promise behind the debt. And when trust erodes on both fronts at once, the effects ripple through everyday life: savings, prices, jobs, all at once. Here's the one line to remember. Hyperinflation destroys what money is worth, and debt default breaks what money was promised. And that brings us to the end of Season 3. Government finance and public money, from money supply all the way to the extremes of hyperinflation and default. Thank you for learning with us. Season 4 is coming, and it's called Wealth. We'll be shifting from how money moves through economies to how it moves through your life. If MoneyMind has helped make finance make sense, hit subscribe so you don't miss it. See you in Season 4,